In 1910, 6 men boarded a private train in New Jersey under fake names and disappeared for 10 days to an island off the Georgia coast. What they drafted in secret became the blueprint for a system that now touches $80 trillion in global debt, shapes every price you see, and determines whether your paycheck buys more or less each year. That meeting has been public knowledge for nearly a century. But the lie isn't that it happened. The lie is about who's actually in control now. Because here's the real question almost nobody is asking. If the Federal Reserve is supposedly independent, and the government supposedly prints the money, and the banks supposedly just follow the rules, then why does it say Federal Reserve note on every dollar in your wallet? Why do the biggest banks own shares in the system? And why has wealth inequality exploded in lockstep with the expansion of the Fed's balance sheet? The answer is not what you've been told. The Federal Reserve is a hybrid, part public, part private. The Board of Governors is appointed by the President, confirmed by the Senate, and operates as an independent government agency. But the 12 regional Federal Reserve banks are structured like private corporations. They have shareholders. Those shareholders are member banks. About 38% of the nation's roughly 8,000 banks are members, and by law, they must buy stock in their regional Fed bank, equal to 6% of their capital. That stock isn't normal stock. You can't sell it. You can't trade it. And it pays a dividend capped at 6% annually. So the member banks technically own the Fed, but they don't control it. Policy is made by the Federal Open Market Committee, dominated by presidentially appointed governors. You have a system where private banks own the infrastructure, fund the operations, and get a small guaranteed return. But the government controls the decisions. Treasury. In recent years, that's been tens of billions of dollars. But the Fed's balance sheet now sits at roughly $6.7 trillion. That's trillions in Treasury securities and mortgage-backed securities it bought to stabilize the economy during crises. It created that money out of thin air. And those banks, the same ones that own shares in the Fed, were the first recipients of that liquidity. So the Fed isn't privately controlled in the conspiratorial sense, but it isn't purely public either. It's a machine built by bankers for a banking system, with a governance structure that insulates it from direct democratic pressure, while embedding the biggest financial institutions at every level of its operation. Let's go back to that meeting. November 1910. Senator Nelson Aldrich orchestrated the trip. Joining him, Frank Vanderlip, president of what would become Citibank, Paul Warburg, a German-born banker, Morgan, Piatt Andrew, assistant Treasury Secretary, and Arthur Shelton. They traveled under first names only. They told the press they were going duck hunting. They spent 10 days at the Jekyll Island Club drafting what would become the Federal Reserve Act. The plan proposed a reserve association with regional branches. Each branch would be governed by boards elected by member banks. The system would hold reserves, issue currency, and set interest rates. It was sold as decentralized to calm public fear of a European-style central bank, but designed to coordinate nationally. In December 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The meeting stayed secret for over 20 years. By then, the Fed had already navigated World War I, the boom of the 1920s, and the collapse of 1929. The men at Jekyll Island were bankers. They wanted stability, but they also wanted a lender of last resort, access to liquidity in a crisis, and a mechanism to smooth out violent boom-bust cycles. They got all three. And in the process, they created a central bank that could expand the money supply on demand and insulate monetary policy from political pressures that might force accountability. So here's the uncomfortable truth. The Federal Reserve was designed by a small group of bankers in secret, passed into law with minimal public understanding, and structured to balance private interests with public legitimacy. That's not a conspiracy theory. That's history. And the fact that this is openly discussed by the Fed itself doesn't make it less troubling. It means the system isn't hidden. It's hiding in plain sight. Now let's talk about the money itself. Every bill in your wallet says Federal Reserve note at the top. Not United States dollar, not Treasury note, Federal Reserve note. That's a legal and historical marker of who issues the currency. The Federal Reserve Act centralized currency issuance under the Fed, which orders physical bills from the Treasury's Bureau of Engraving and Printing. There's now about $2.4 trillion in physical currency circulating globally. But physical cash is a tiny fraction of the money supply. The real action is in digital money. When the Fed buys a treasury bond from a bank, it doesn't print cash. It credits the bank's reserve account. That's new money created with a keystroke. During 2008 and 2020, the Fed expanded its balance sheet by trillions, purchasing government debt and mortgage-backed securities to inject liquidity. The member banks were the direct recipients. Some of that money flowed into the real economy. A lot of it stayed in the financial system, inflating asset prices, stocks, bonds, real estate. So who profits when the Fed prints money? The government benefits because the Fed's bond purchases lower borrowing costs. The national debt crossed $37.6 trillion, adding $217 trillion in a single year. Banks benefit because they get liquidity and first access to cheap money. And asset owners benefit because the flood of money pushes up prices. Meanwhile, people who hold cash or earn wages see their purchasing power erode through inflation. This is the hidden transfer. Inflation acts as a silent tax, redistributing wealth from savers and wage earners to borrowers and asset holders. Between 2020 and 2022, inflation spiked above 9%. Wages for low-income workers rose, but not fast enough. Households earning $25,000 to $35,000 were 19.3 percentage points more likely to report severe financial stress than higher income groups. Meanwhile, the stock market hit record highs. Real estate values surged. The wealth gap widened further. So the Fed isn't stealing your money in a literal sense, but it is managing a system where money creation flows first to banks and asset markets, and only later to wages and Main Street. That's not a bug, it's the design. Let's talk about the $80 trillion lie. You've probably seen headlines claiming the Fed controls $80 trillion. The Fed's balance sheet is around $6.7 trillion, not $80 trillion. So where does that number come from? Credit market debt, household, corporate, financial sector, and government debt combined. The Fed doesn't control all that debt, but it does control the price of it. By setting interest rates, the Fed determines the cost of borrowing for every participant in that $80 trillion system. When rates are low, debt is cheap and the system expands. When rates are high, debt is expensive and the system contracts. And right now, sustainability is the question. National debt is $37.6 trillion and rising. Debt, held by the public, is about $30.3 trillion. Roughly 115.5% of GDP. That ratio has doubled in 20 years. Interest payments on the debt are now over $600 billion annually. If interest rates stay elevated, those payments will rise, crowding out other spending or requiring more borrowing. This is the debt spiral, and the only way out is for the Fed to step in and buy that debt with newly created money, which brings inflation, which erodes purchasing power, which transfers wealth, which widens inequality. It's a loop, and we're deep inside it. This isn't new. This is a cycle that repeats across history whenever society builds a financial system on credit and central control. Here's how it works. Stage 1. A crisis creates demand for a central authority to stabilize the system. That was the panic of 1907. The Federal Reserve was created 6 years later as the permanent solution. Stage 2. The central authority gains the power to create money and manage credit. We left the gold standard domestically in 1933 and internationally in 1971. Once money creation is untethered, the system becomes fiat. Money backed by trust and law, not commodities. Stage 3. Governments and banks realize they can solve short-term problems by expanding the money supply. The incentives all point toward expansion because contraction is politically painful. Stage 4. The expansion creates imbalances. Debt grows faster than income. Asset prices rise faster than wages. Wealth concentrates among those closest to the money creation process: banks, financial institutions, and asset holders. Stage 5. Inflation becomes persistent. Central banks raise interest rates to cool inflation, but higher rates make existing debt harder to service. Stage 6. Trust erodes. People begin to notice the pattern. They see currency losing value, debt rising, elites profiting. Conspiracy theories flourish because the official explanations feel disconnected from lived experience. Stage 7. The end game. Either the system resets through crisis, or it transitions to a new monetary regime. History is full of examples. Weimar Germany, the collapse of Bretton Woods, the Asian financial crisis. So which stage are we in? We're somewhere between stage 5 and stage 6. Inflation spiked. The Fed raised rates, and now we're in a holding pattern. Debt is near record levels. Wealth inequality is near record levels. Trust in institutions is declining. If the Fed keeps rates high, debt becomes unsustainable. If it lowers rates, inflation risks returning. Every option has costs. Let's ground this in the present. JP Morgan Chase, the largest U.S. bank, holds about $3.46 trillion in assets. Goldman Sachs Bank USA holds about $558 billion. Both are systemically important. The Fed supervises them, but those same banks own shares in the Fed. As of 2018, Citibank and JP Morgan owned 42.8% and 29.5% of the New York Fed's capital stock. They also elect 6 of the 9 directors of the New York Fed's board. So the Fed regulates the banks, but the banks own part of the Fed and help choose its leadership. The policies that result tend to prioritize financial stability for large institutions over wealth equality or democratic accountability. When the Fed intervened in 2008 and 2020, it saved the banking system, but it also reinforced moral hazard. Banks can take risks, knowing the Fed will backstop them. There's also the global dimension. The dollar dominates international trade because of the petrodollar system. Struck deals with Saudi Arabia. Oil would be priced in dollars in exchange for military protection. This created permanent global demand for dollars. About 80% of global oil transactions are still conducted in dollars. Treasury bonds. But the system has a weakness. It depends on other countries continuing to trust the dollar. If major economies start trading oil in yuan or euros, demand for dollars falls. China is promoting the yuan for trade. Russia has reduced dollar reserves. BRICS nations are discussing alternatives. The cracks are visible. So what does this mean for someone with a mortgage, a job, and a shrinking paycheck? It means you're living inside a system where the rules benefit those closest to the money printer. If you own assets, you've likely seen your wealth grow. If you rely on wages, you've likely seen your purchasing power stagnate or decline. Households hold about 3% of total wealth. The top tier holds exponentially more, and that gap is widening because of systemic design. Now let's talk about what comes next. There are a few plausible paths. Path 1, manage decline. The Fed continues walking the tightrope. Debt keeps growing, inequality keeps widening, trust erodes. This is where we are now, and it could continue for years. The cost is a generation that works harder for less. Path 2, inflationary blowout. The government leans on the Fed to keep rates low. The money supply expands faster than the economy can absorb. Inflation returns persistently. Savings are wiped out. The wealthy who own hard assets are insulated. Everyone else suffers. Path 3, deflationary crash. The Fed raises rates aggressively and refuses to backstop the system. Debt becomes unsustainable. Asset prices collapse. Unemployment spikes. The economy contracts sharply. Path 4, systemic redesign. A crisis forces a rethinking of the entire monetary system. Maybe it's a central bank digital currency. Maybe it's a multi-currency world. 137 countries are researching digital currencies covering 98% of global GDP. Launches a digital dollar. It could give the Fed unprecedented power to monitor and control money. Each path has winners and losers. None leave the current system intact. The question for individuals is, if you know the pattern is real, what do you do with that knowledge? You can't opt out of the dollar system entirely, but you can position yourself. You can diversify into assets that hold value when currency doesn't. You can reduce debt. You can educate yourself about how money works. And you can demand accountability. Because here's the final reframe. The $80 trillion lie isn't about a number. It's about the illusion of control. The Fed doesn't control $80 trillion, but it controls a system that generates and manages $80 trillion in debt. And that system, built in secret over a century ago, serves its architects better than it serves you. The Federal Reserve note in your wallet is a daily reminder. This is their money, their system, their rules. You just live inside it. The conspiracy theories persist not because people are stupid, but because the official story feels incomplete. You're told the Fed is independent, but it was created by bankers. You're told it's public, but private banks own it. You're told it serves the economy, but wealth inequality explodes every time it expands the money supply. Some of the theories are false, but the truth is almost as uncomfortable. The system doesn't need a conspiracy. It runs on incentives. And those incentives are baked into every policy. So the real question isn't who controls the dollar. It's whether a system designed by elites for elites in 1910 can ever serve the majority. And if not, what comes next when trust finally breaks? If this gave you a new lens on what's actually happening, subscribe. The answers are rarely in the headlines. They're buried in the history most people ignore and the patterns that repeat until someone finally sees them clearly. This is one of those patterns, and now you've seen it.